You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. How are you doing this Monday? I hope that you had an amazing weekend. I was in Boise. That was a lot of fun, and now I'm back with a lot of energy. It will require a lot of that because today I am looking at the income illusion created by HHIS Diversified High Income ETF. HHIS.TO has been incredibly popular among income-seeking investors since it was launched this January of 2025. So first things first, I'm not going to bring any opinion on that. I'm going to bring numbers, and then you do whatever you want. So I'm not telling you to buy it. I'm not telling you to sell it. I'm just telling you what I've seen so far since January. And of course, it's not long enough to draw a complete conclusion, but I mean, I'm not going to wait like 7-8 years to do that because you need at least 7-8 years, a full economic cycle, not just like, oh, the stock market dropped on Liberation Day and it recovered, so it went through a full cycle. No, that's not a cycle. That's like every day on the market, it goes down 10%, it goes back up. That's not a real correction. The real thing is 5, 7, 10 years going through recessions, crisis, and everything else. That's the real test. We're not going to do that today, of course, but we're going to get back to a choice I would like to offer you. You have like 2 job offers in front of you. So offer number 1, you get $100,000 a year, and chances are that your income will increase by around 7% per year. Sometimes it will drop, but I mean, it's variable income, but roughly $100,000 a year, which technically should increase over time. The other job offer is you get $125,000, so $25,000 more than the original offer. But if you don't buy a worth of like $25,000 of your employer's share, well, then your income is likely going to go down next year, and maybe you're not going to be able to keep your job for the long run. So as long as you keep buying $25,000 each year and you don't skip a year to buy yourself like a boat or a car or go on vacation, you really just have $100,000 that you can use, and then the extra 25, it needs to be bought back into your employer's share. So my question to you is, first, which job would you take? I mean, the 125 will likely give you about the same returns of the 100, but you cannot get access to that extra $25 ever. And probably that you're going to make a bit less money, actually. So tough decision, right? Not enough information. But let me ask you a second question instead. What is your income? Is it really 125 if you select the second one, or if it's 100? Because you're never going to touch that extra $25,000 unless you're making sacrifices. And that's a little bit of what's HHIS Diversified High Income ETF, HHIS.TO, is offering. Right now, as of June 6th, actually last week, the price was $11.47 for a unit. The distribution was 25 cents for a whooping distribution yield of 26%. That means that if you hold onto your shares for 4 years, you get your entire capital back and you make it like a villain. Even better, if you have $200,000 today, you can invest that into HHIS and based on that 26% distribution rate, live on $52,000 a year for the rest of your life. $50,000 a year only with $200,000. That's kind of crazy, right? I mean, that's like a full defined pension plan. Like, I don't know. I don't even know if it like teachers that work their entire life can get like that $52,000 a year, or roughly. I don't want to insult anyone. I don't know that, but I mean, $50,000 a year, $200,000. That's super easy. I could retire. Like, I could have retired like at the age of like 35 with this. That's kind of crazy. But is it income? Let's go back a second. Let's take a look at this. So on January 16th, that started to trade. So you could have bought units at $12.38. Imagine that you have your $200,000, you buy it at 12 bucks 38 cents. That gives you 16,000 shares, like 16,155 to be exact. With that monthly distribution of 25 cents a unit, you would get $4,000 per month. I mean, it's like 48.5 thousand, not 52 anymore, but still, I wouldn't spend on that, right? I mean, like $4,000 a month for the rest of your life with $200,000. That sounds like an amazing deal. So far, someone who bought it in January got 4 payments, including the one in June that was paid on the 9th. So February, March, April, June, $4,000 every single time for a total of roughly $16,000, right? But as of June 6th at $11.47, the $200,000 today is worth $185. But who cares, right? I mean, you got $4,000 a month, so you're golden. But here's the thing. If you use $185,000 plus the $16,000 that you have received, you're slightly over 201. So is it really like a 20% distribution, or are you getting your money back? Because literally your asset started at 200K. And if you count the number of dollars that you have received in distribution, you're slightly up. So you didn't lose any money. That's fair. And this is exactly that. Those are the numbers. But did you really get 20% income on that? Not really. I mean, too early to tell, of course, for the long run, what's going to happen with this. And I'm not going to tell you that the 185 is going to go down to 150 by the end of the year or whatever. But I'm just saying, like, for the first 5 months, you're barely making it in terms of total return, which is fair because the HHIS invest in a lot of US popular companies, great companies. So technically, it's all good. It's, I mean, should be up maybe like 1 or 2%, maybe a few $1,000 more, but not that much. So it's not the end of the world. So a lot of people will say, but Mike, I don't get the income. I reinvest. I use that income from my HHIS to buy more shares. And I'm like, okay, fair enough. Let's do the math again. I mean, it's only 5 months, so it's super easy, right? So on March 7th, you received the money. You bought another 368 shares at $10.97. 97 cents. And then on April 9th, you buy a little bit more, and then you got more. So you bought even more. So you have like that snowballing effect. So on March, you buy 368 shares, and then in April, it's 406, and then in May, it's 390 because the price increased a little bit, and in June, you're going to get another like 4,300. Instead of like 4,000, we're at like $300 more. That's great. So I want to see, on June 9th, the price was $11.63 times the 17,300 shares that you have accumulated. You are up to $201,000 plus the $4,000 that you're going to receive in distribution. I mean, roughly calculating $205,000, $750. So almost $206,000 after all of this. So $6,000 more than your initial investment that you made in January, but you did not touch a single dollar in income during that period. You just reinvested every single thing. So yes, that's great because it's compounding and you did not lose money. But did you get any income of that? No, because you could not receive that money and actually spend it in your retirement. So if you're retired in January thinking you can retire on kind of like an annuity like of like $4,000 a month, if you did that, I mean, your portfolio is down to 185. And so far, you're still getting the $4,000. But do you really think it's going to continue for the next 30 years of your retirement? I don't know. I'm just asking the question. So you're not losing money, but if you keep on taking that $4,000 off, it seems to me it doesn't look really sustainable. But maybe it is. But I don't know. I just see the investment portfolio value going down, and you get the same income. So first, at one point, if you need more income than this, it's not going to work because I haven't seen any increase in the distribution. Finally, what I did is I created the portfolio based on the 15 stocks it has for HHIS on January 16th. And I used exactly the same weight for each stocks. And if you had invested $200,000 back then in that portfolio, that would be worth 220 today. There is currency fluctuation that will affect that, but I mean 220 versus 205, I'm pretty sure that even if you factor in the currency, the 220 will be better, right? But again, those are numbers. So I'm going to keep on following on HHIS, probably later down this year, probably at the end of the year, to see the full 12 months at least, going to get a little bit more information. But just want to highlight that if you're taking the money today, that $4,000 in income, your portfolio value is going down. So I don't know how long it's going to continue to generate $4,000 a month in income. Is it realistic to think that you can retire with $200,000 and generate 50 grand a year forever? I mean, forever, 20, 30, 40 years, right? I don't know. I'm going to let you be the judge of that. I'm going to just continue to report the numbers. And if you have any questions, you're more than welcome to jump in the discussion on my YouTube channel and ask me any question about HHIS and see how it goes. All right, Moose, that's enough for today. We're going to talk again tomorrow. But until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.